Hello, my name is Lachlan St. Clair and welcome to the May edition of CSP Smart Money. We're coming up on the run into the end of the financial year, and for a change there's not a huge amount of legislative adjustment required this year. Really the key one, and most of our clients have gotten back to us on this one already, I should say, is the halving of the minimum pension payment. So if anybody has a pension payment, was receipt of a pension payment through their self-managed super fund or through a commercial trust, be advised that pension payment has halved, and we've spoken to most of you. If this is news to anybody and you haven't yet spoken to us, please feel free to give us a buzz and we'll just have a quick chat through the implications for you. For the balance of this Smart Money, we've got a bit of a special surprise. I've been able to get some of Jamie Nicol, and Jamie Nicol's the Chief Investment Officer at Dalton Nicol Reid, get some of Jamie's time for a one-on-one interview and just to get his thoughts on the current market, where he sees opportunities and what his views are on the current macroeconomic outlook. So we'll throw over to Jamie now for a bit of an update. Hi Jamie, thanks for making some time available to us. Really appreciate your time. Wanted to start off with just sort of, I guess, one of the questions that's been certainly dominating my mind, and that's to do with the economic outlook and this apparent disconnect between, what's some pretty ordinary economic data globally. I mean, it's just an amazing economic data globally, and where the equity markets are sitting, both domestically here and internationally. Have you got a comment on sort of, do you agree with that dislocation? And if so, do you have any idea?
Yeah, there's a massive dislocation. The way we're thinking about it is a few ways. I think, firstly, the size of the fall in March was massive, like 38% in a very short space of time. The reason it fell so much and so quickly was because everybody could see economies hitting a brick wall. And we all could all see it coming. And we think since mid-March, that was when fear was at its greatest, when people were concerned about the number of people who were going to die, the number of people who were going to be in hospital. You didn't know how long the economy was going to open. You were running scenario tests about the economy staying closed for 6 months, maybe 9 months. It was very dislocated at that point. Whereas I think that fear has eased, and as a result, markets have started bouncing, but still the economies are still feeling the effects of that decline.
Okay, gotcha. So what are you hearing from your corporates? I've spoken a lot to my clients about governments trying to protect balance sheets so that when we come back out of this, there's an economy left to switch back on.
Yeah.
What are you sort of hearing at a corporate level about the condition of those balance sheets, I suppose, and do you hold any genuine fears about any broader scale corporate collapses in Australia?
I think it's inevitable that there will be some collapses, but we're not really seeing any near-term issues from the major companies that we look at. I think the thing that is different this cycle to, say, last cycle is, again, because we've hit a brick wall, everybody's right on the issue, both governments and also leaders of major corporates. There's no false optimism about the potential consequences of the slowdown. So people have been fast to react. They've looked at making sure they've got liquidity. I mean, that's been the most important thing. And I think banks have been pretty supportive of corporates in that regard. There's been lots of capital raisings to ensure that they've got a balance sheet to survive a crisis, and making sure that debt levels are appropriate. I think there's been a lot of de-gearing amongst Australian corporates. And I think going into this crisis, if I can compare Australian companies compared to the US, I think our balance sheets were in pretty good shape by and large. So that was always noticeable to me every time I went to the US, just the level of gearing in the US compared to the Australian companies. So I don't feel too bad about corporates. I think the one area in Australia that is a little stretched is households. There is still a fairly high degree of leverage amongst households. So some concerns around how the mortgage market plays out. I still think that's sort of an area that has some concerns for markets.
Well, those stretched balance sheets at a consumer level, do you see that tipping over into the banking sector in Australia?
Possibly. I mean, we're still a little uncertain about what the bank's balance sheets are going to look like in a few months, because at the moment about 7% of their balance sheet is on a repayment holiday. And so you've still got these zombie-like loans, and you're not sure how many of those customers are going to be happy to pay come the end of JobKeeper and the like. So that's creating a little bit of uncertainty for the banks, which is one of the reasons we're quite underweight that sector. Their balance sheets are in good shape relative to the GFC, though. So I don't think we've got the same level of concerns around solvency that some of the financial sector suffered from during the GFC.
Yeah, gotcha. Okay, obviously with that macro environment, really the economic trajectory is so unclear. It's really sort of hard to see what the world can look like in 12, 18 months' time. What do you and your team focus on during periods like this?
So first and foremost, we focused on balance sheet and liquidity. That's what we did through most of March. Just make sure that we thought our companies were going to be able to survive in the first instance. Then the second thing is we're not really sure about the shape of the economic recovery, just how strong it's going to be. Is it going to be V-shape or L shape or U shape? Everybody's got a different letter of the alphabet in terms of the economic recovery. But what we're doing is just stress testing our assumptions across our companies. If we've got a company with a higher degree of exposure to the economy, like something like James Hardie, which we own, if we think the market's forecasts are really quite a severe, quite a negative sort of type scenario, and it still looks cheap, well, then we're happy to buy and happy to continue to own that company. Alternatively, a company like Ramsay Healthcare, which we bought during the crisis, that stock got sold off about 40% because elective surgeries were down. Yet we think elective surgeries will come back very quickly, and those strategic value in those hospitals will be there. Those earnings will recover very quickly. So that stock's bounced quite strongly off their lows through that March period.
Okay. I suppose I've got to ask a question because a couple of clients have been asking, tourism in the airline industry, is Virgin going to fold? Do you think someone will come in and take it out?
Absolutely. I think Virgin's at risk of folding. In terms of the slots, though, at the end of the day, the domestic slots are valuable. The domestic routes are quite profitable, and perhaps they need to restructure some of their contracts with various unions and so forth. But I think they can emerge on a profitable footing, whether it's in the guise of Virgin or a different brand. I'm not sure at this stage. I think the broader travel industry will be a laggard in terms of sectors. I mean, I was very surprised to see the Queensland Premier decide to keep borders closed until September. That seems like a really surprising decision from my perspective. And I think a big restriction is going to be just the willingness of people to travel. I think a lot of corporates will start to move to do business, but perhaps non-discretionary travel will be a bit delayed. So when we look at a stock, we own some Sydney airports, and we're really valuing that on 23 earnings and thinking that they'll be back to about 90% or 95% of where they were in 2019 by 23. And at that point, it's still going to offer you about an 8% yield in 2023. So I think in a low interest rate environment, that's pretty good. And as a result, this bit of stock we've been happy to own, but it won't be a sector that recovers quickly.
Yeah, gotcha. Are there any other sort of opportunities you're seeing in the Australian market at the moment?
Where we went in March and April was by great businesses trading at cheap prices, and there was plenty of them. I mentioned Hardee's and Aristocrat. Aristocrat, you'll know it owns poker machines, but it also does a lot of digital games. And as people have been stuck at home, they've been happy to play a lot of games on their computers, and the profits on that type of activity has gone through the roof. And their competitors have got too much debt. So it's a sort of, often the strong get stronger through a crisis, and those businesses can continue to invest in R&D, continue to invest in their staff. They can emerge with more market share. I think something like Aristocrat does that. Another company that's sold off in recent months has been Computershare. Computershare does share registry business. It also looks after distressed mortgages in the US and administers bankruptcies. And it's sold off because it has a lot of money that sits at cash at bank, and as interest rates have fallen, their profits have fallen. But interest rates are so low now that even if interest rates would go to zero across the world, it has very little impact on their profits. And the market's forecasting that, but it's not forecasting any improvement in earnings, which can come from higher bankruptcies, higher delinquencies in mortgages, higher corporate actions like capital raisings and M&A activity. So they've got a range of counter-cyclical activities that can really provide a benefit. So we like that because we think it's pretty cheap and there's not much downside to earnings, but plenty of upside. And so the asymmetric risk, which is always attractive.
Yeah, absolutely. Absolutely. And so one other stock question to ask you, again, a number of clients have asked me about this one, CSL. What are your thoughts on, I mean, not everyone knows it's a great company, but I guess it's a question of valuation.
Yeah, look, it's a great company. And look, it's one we would have liked to own over the last year. It's done incredibly well. It's one that we do feel is expensive at 45 times earnings. The broader markets trades at about 16 times earnings. So it trades at north of 2 times the market valuation. And despite being a great company, we think there are some headwinds to earnings. They collect blood from various centers across the US, particularly along the Mexican border, which is shut. So that's having restrictions on supply. And some of their competitors are improving. And this is only at the margin, mind you, but for a stock trading at 45%, you don't really want to have any hiccups. So for us, we can just find better opportunities.
Yeah, gotcha. And is it from a global macro perspective, is there anything that you're sort of really watching that would be an indicator as to the shape of that recovery? Any sort of early indicators? I guess the second wave is the one that comes to mind, obviously, but is there anything else you're watching?
Vaccine, treatments, testing regimes. I think that all of those things that allow the economy to go back to normal is critically important. We're also watching China to see how, given China's a little bit earlier on in this crisis, to see how they recover. I think it's another important area. Two other areas we're thinking about is just whether we start to see some inflation due to all the stimulus and the change in sort of the priorities around globalization. A lot of people are concerned around having too much supply in China, and as we pull back that to domestic markets, that can have an increase in inflation. That's another area. So there's just a lot of macro factors at the moment playing out, and to keep an eye on. But I think the biggest priorities will be that second wave, and then vaccines and treatments. I think those are two key crucial areas.
Yeah, gotcha. And just one last question to China now that you raise it. Obviously, been a bit of not sure what the political word is, but a lot of argy-bargy and threats to cut off barley and threats to cut iron ore and coal and all the rest of it. Do you see it as anything? Does it cloud your view, or does it take
it can do
the economy?
Yeah, it can do a little bit. Look, I am a little bit cautious around the whole political environment. I think coming into an election year for the US and seeing greater polarization in political policies, I think it creates some uncertainty for markets, as does the relationship with China. I think China obviously feels under pressure. I think a lot of corporates are talking about creating greater diversity in their supply chain after the incidents. I think China does need to show a bit more transparency in terms of their dealings with the West. I think it's for the long-term benefit of China if they were to do so. So I do have some concerns about that. Whether the concerns are directly related to Australia is difficult to tell. I think China's fighting on a lot of fronts at the moment. The Brits, the French, the Americans, Australians. So we're not out on our own. I don't know whether they want to have too many fights going on while their economy is still struggling to recover. When we speak to various companies operating in the US and speak to the Chinese, like Treasury Wines, which sells wine in the US, in China, the Chinese still got good demand for Penfolds. Chinese students have still got heavy demand to come to Australian universities. I don't think brand Australia's been damaged at all. If anything, I think it's been enhanced by our handling of the crisis. So long as there's not too much of an autocratic crackdown on Australian exports, I think it'll be short-lived, but something to watch for sure.
Gotcha. Fantastic. Okay, Jamie, look, we'll leave it there. As I said, it was just intended to be just a quick catch-up to just get your temperature and your thoughts on the market. So I really appreciate you sharing the time with us, mate. We'll talk to you soon.
No worries. Thanks.
Okay. Well, fantastic. Thanks, Jamie. Well, that's it from us for this edition of CSP Smart Money in May. If there's any other questions you'd like, or if you need to get in contact with the office, please feel free to give us a buzz. Otherwise, we look forward to talking with you soon. Thank you very much.